Let's look at my Excel calculations for this example. Remember, Blue Hedgehog was a private company, and we were looking for this company's actually levered beta by using comparables or bottom-up beta. Remember, we have three comparable firms, all of which were public companies, namely Salesforce, Adobe, and Workday. So starting from Salesforce, actually, we relied on the information on investing.com. So your time period again starting from 2019 and ending at the end of 2023, and we have the price measurements, but based on these price measurements, actually what we need to measure is monthly returns on Salesforce stock. So remember the drill, the last value minus initial value and divided by the initial value. So you need to calculate all these monthly returns on Salesforce. Then of course you need the monthly returns on uh, market portfolio, which is S&P 500. So the index value for S&P 500 will come from Fred database. We have the index values in here. So last value minus initial value divided by the initial value. This is the monthly returns on S&P 500. So I moved these values to a column that is next to the column in which I calculated the monthly returns on Salesforce. I just put the monthly returns on the market portfolio in here. We also need to calculate the average returns on of these monthly returns for both Salesforce and S&P 500. Remember, because we need to calculate the deviations from the mean for each stock or each market portfolio. So here for Salesforce, remember these were individual measurements minus the average value. This is the deviation from the mean. Do this for all individual measurements in terms of monthly returns, and we will be doing the same for S&P 500 as well. So monthly returns minus the average value, this will be the deviations from the mean for S&P 500. But for S&P 500, actually, we need to take the square of these deviations from the mean because we will be calculating the variance of the returns on the market portfolio while we were calculating the beta of the sales for stock and equity beta or levered beta, more precisely speak. For covariance, remember covariance is actually the average of the products of these deviations from the mean. So actually what you do, deviations from the mean for Salesforce, deviations from the mean for S&P 500, you will multiply these two values and add them up and divide them by the number of observations minus one. Actually, this is the average of all these product values, and you can calculate this in a longer way by using sum product function, sum product of these deviations from the mean for both Salesforce and S&P 500, and divided by number of observations minus 1. In the denominator, we have number of observations minus 1 because we are following the sample convention. This is the past data. We are not looking at the population. We are looking at the sample. And also for the variance, remember this is the deviations from the mean for S&P 500 squared values. Actually, deviations from the we squared all these deviations from the mean numbers. So actually what we do here is we are just taking average of these deviations from the mean S&P 500 squared values. We sum them up and we sum them these values and divide them by the number of observations minus 1. So this is the variance of the return on the market portfolio, and covariance divided by the variance. This is the beta value, beta of the Salesforce, levered beta or equity beta of Salesforce. And for the covariance, actually you can just use Excel functions as well. For example, for the covariance, just use the covariance S function. What will be your arrays? First array will be monthly returns on Salesforce, and second array will be monthly returns on S&P 500. So do this here. And for the variance, actually just use the variance as function monthly returns on S&P 500. This is the market portfolio. And again, covariance divided by the variance. Actually, this is the beta of your stock. Or you can just create this plot, S&P 500 returns being the horizontal axis, and Salesforce returns will be the vertical axis. So 5 year back, monthly convention. All these points are just measurements, uh, measurements, and just what we do is actually doing the linear fitting. This is the linear line based on these measurements, and the slope of this line will be beta of the Salesforce, which is the same as those values calculated above. And then, of course, this is a levered beta. We need to calculate unlevered beta. So remember, we have total liabilities numbers, total stockholders' equity numbers. These were book values, and also revenues and EBIT values will come from the company's income statement. Change in revenues, change in EBIT, and change in EBIT divided by change in revenues will give you an approximate an estimation for the operating leverage of Salesforce. And by looking at these values, you can say that actually this is a very unstable operating leverage varying across these years. And then you need to calculate debt to equity for each of these years. Actually, it is more stable. Just take the average debt to equity ratio, because again, even if there's less variation in debt to equity, we are conventionally using the average value. Tax rate was 21%, the statutory tax rate, and beta levered. Remember, we already calculated levered beta here, and then you need to calculate the unlevered beta based on these values. Remember our formula. This is the equation that governs the relationship between the levered beta and unlevered beta. So unlevered beta in this case will be levered beta, the value we calculated in the previous step, the levered beta divided by 1 plus 1 minus tax rate and multiplied by the average debt to equity ratio. So this will be the unlevered beta for Salesforce. I'll also calculate the firm value, which is actually the book value, the sum of the book values of total liabilities on total stockholders' equity, which is actually the book value of the firm's assets in that case. And this is for the Salesforce. We will be following the same procedure for the remaining comparables, namely Adobe, and the last one was Workday. So again, calculate the monthly returns on Adobe stock, calculate monthly returns on the company's on the market portfolio, and so deviations from the mean for both Adobe and S&P 500, deviations from the mean for S&P 500 need to be squared because we will be calculating the variance of the returns on the market portfolio. And then algebraic solution, again, you can use the sum product and divide it by number of observations minus 1 in the denominator because of the sample convention. Or for the variance, again, the average value of these deviations from the mean squared values, and the beta will be covariance divided by the variance, which is 1.34 or so. Or you can just use the Excel functions, the sample Excel functions for covariance and variance. You will be getting the same numbers. You should be getting the same numbers. And of course, beta will be covariance divided by the variance. Or you can just create this plot, and doing the linear regression, the slope of this linear curve should be the equity or levered beta of Adobe. And again, we will be doing the same. We will be completing the same steps as we did before for Salesforce. So total liabilities, total stockholders' equity, book values, revenues, and EBIT. Actually, revenues and EBIT will only be used to approximate the operating leverage of the company. So change in revenues, change in EBIT, change in EBIT divided by change in revenues. This is the operating leverage. Again, actually, it varies across the years, but it seems to be a little bit stable. And debt to equity ratio, remember, as we did before, total liabilities divided by total stockholders' equity. It is also somewhat stable, and we take the average of these values to get the average debt to equity ratio. tax rate was 21%, beta leverage was already calculated.